Assalamu alaikum. Dear student, let us start IAS 12. You might be looking the question 145 and sir is talking about IAS 12. Yes, the time has come that we should discuss now IAS 12 income taxes. In the previous lecture, we completed ratio analysis and alternative performance measure. And the previous video was a very small video, hardly 30 minutes, maybe 33 minutes. Now the time has come, dear student, that we should be discussing IAS 12, the favorite of all, income taxes. That's my favorite, it's your favorite, and it's a favorite of everyone. Income taxes, IAS 12. Number one, for in income taxes IAS 12, we have few concepts which are very important we need to discuss. One by one, we'll be discussing all those concepts. Number one, there's a concept called over provision of income tax. Over provision of income tax. The question is, what do you mean by over provision of income tax? For example, in 2022, APLC recognize income tax payable. As you can say simply tax payable. No. Assuming in 2022, APLC recognized the tax payable of 20,000. Okay. That was on December 22. Let's make an assumption. They made the payment on 2023. The payment date was 31st March 2023, means the tax payable of 2022 was paid on March 2023. Normally, when you will be making the payment on that day, you will come to know the exact amount which you are supposed to pay. Let's say the tax authorities are saying the final payment of APLC is 18,000. APLC recorded 20,000 in 2022, but the final liability which tax authorities they are asking, it is 18. It means you have recorded 2,000 additional in the previous year. So what will be the entry in March 2023? Debit and credit. This is basically your current tax payable. In 2022, the entry of current tax payable is simply current tax expense debit by 20,000. Tax payable is credited by 20,000. And now we are making payment, and tax authorities they are asking us just to make payment of 18,000 full and final. So for the liability of 2022. So look at the debit. Your tax payable will be debited by 20,000. Tax authorities they are just asking 18. Then income tax expense will be credited by 2,000. Simply, if you have made over provision the previous year, so what happens? Over provision reduces the current year income tax expense, which can be seen. I'm crediting the 2,000. So note over provision of income tax reduces current year income tax expense. Okay. There's another concept which is called under provision. Under provision means that you made you have recognized the tax payable which is less than the required payment. Now assuming, for example, 2022, APLC recognize a liability of current tax payable assuming 20,000. Current tax payable is 20. But March 2023, when they were asked to make the payment, tax authorities have told them your actual payment is actually 22,000. Make it, let's say 23,000. So tax authorities are asking 23,000 for the liability of 2022 to be settled. But APLC has recorded only 20. Actual payment is more than what they have recorded. So it means the previous year they recorded less current tax payable. So what happens in case of under provision? Number one, tax payable is debited by 20 because you have 20,000 in your books. But this time, dear student, the payment amount is 23, more than what you recorded in the previous year. This is the scenario of under provision. Under provision, what it does, it increases your current year income tax expense. Simply, you need to debit the income tax expense by 3,000. So, under provision of income tax increases current year income tax expense. So simply you need to have a really good understanding of 2 points. One is over provision. What happens due to over provision, your current year income tax expense reduces. If there's under provision, it increases your current year income tax expense. Okay, now move ahead. Another important point which we need to discuss is, what do? We calculate, we make a profit and loss statement and we calculate, let's say, profit before tax. Okay. Let's say you have made a P&L and you have a profit before tax. Now, very important point. The accounting profit which you can get from the income statement from statement of comprehensive income. Basically, entities are not paying tax on their accounting profit. Entities are required to pay tax on their taxable profits, which means that we take accounting profit of the business and through some adjustments, we convert this into a taxable profit. So actually the tax rate is not applicable on accounting profit. Tax rate is actually applicable on taxable profit. So through some adjustments, we convert accounting profit to become taxable profit and then basically taxable profit into tax rate. That gives you the current tax payable. Taxable profit into the tax rate basically gives you the current tax payable. Because we do not pay tax on accounting profit. Basically we pay tax on taxable profit. So through some adjustments, we convert accounting profit to become taxable profit. So let me give you the examples of few adjustments. For example, profit before tax. I'm just assuming the data from just an assumption in order to just bring the clarity in the format. Assuming we have a profit before tax 1 lakh. Simply you need to add back accounting depreciation because tax people don't accept accounting depreciation. Simply add back accounting depreciation. Okay, assuming it is 5,000. You need to add back accounting amortization if you have. Add back amortization. Assuming 10,000. You need to add back impairment loss because tax people don't accept impairment loss as an expense. Add back impairment loss. Assuming 5,000. if there is any capital gain in your profit before tax, and assuming that capital gain is exempt from the tax, I'm just uh, showing you the format with the numbers that may help. Assuming there's a capital gain in your profit before tax which is exempt, so simply less exempt capital gain, exempt capital gain assuming it is 5,000, and there's any assuming there's dividend income in your profit before tax which is exempt, so simply deduct the exempt income if you have any. Let us deduct the exempt income. It could be dividend income, it could be interest income, provided that if it is exempt, then you need to deduct. Exempt means tax authorities, they are saying it is exempt from the tax, you're not supposed to pay any tax on that. So we'll deduct exempt income, okay? Then simply what do? We deduct tax depreciation, not accounting. So tax people, they will give you tax depreciation assuming it is 5,000. You cannot, basically tax people don't accept accounting depreciation, they accept tax depreciation. So tax depreciation will be deducted. So let's assume that tax depreciation I've deducted. Assuming if there is any allowance for bad debt, that will be added back. Add back allowance for bad debt. Allowance for bad debts because tax people don't accept. Assuming it is 7,000. Add back the warranty provision if you have. Add back warranty provision if any. Because tax authorities don't accept provisions also. And deduct the written off. Tax people don't accept allowance for bad debt, but they do accept written off. If there is any written off, then deduct, assuming 5,000. They don't accept warranty provision, but they do accept the warranty paid. Warranty paid. Let's say 2,000. So I try to give you a format. After doing all this adjustment, plus and minus, you will get taxable profit. Taxable profit. Whatever it comes, taxable profit into the tax rate gives you the current tax payable. Gives you the current tax payable. So basically, and what will be the entry of current tax payable? Simply current tax expense debit and current tax payable will be credited. Okay. Now another concept. Basically what happens in IAS 12, there's a very important concept which I'm going to just tell you. It is possible, now please try to understand what I'm telling right now, what I'm trying to explain right now. It is possible, due to taxation rules, you might be paying more tax in the current year. Even though your taxable income is less, but what tax people did, due to their rules of taxation authorities, assuming your accounting profit was 1 lakh, but when tax people, they followed their rules, they said no, your taxable profit is not 1 lakh, it is 120. Okay, in your books the accounting profit is 1 lakh, but tax people are saying no, it is 120. The taxable profit is 120, which is more than the accounting profit. If your taxable profit is more than the accounting profit, so obviously you will end up by paying more tax the current year. If you end up by paying more tax in the current year, then in the future your tax will be saved. Okay, another scenario, it is possible your accounting profit is 1 lakh, but after the adjustment your taxable profit comes only 70,000. Your accounting profit is 1 lakh, which you know that, but after the adjustment of tax, it is 70,000. Taxable profit is 70,000. If the taxable profit is less than the accounting profit, then you will end up by paying less tax. But if you are paying less tax today, you will be paying more tax in the future. So basically, if you are paying less tax in the current year and more tax in the future, then you must recognize a deferred tax liability. Then you have to recognize a very important concept is coming, that is deferred tax liability. Deferred tax liability. Deferred tax liability comes in your accounts when you have paid less tax in the current year, but in the future you'll be paying more tax. When in the future I'm going to pay more tax, then I should be recognizing a deferred tax liability. So recognizing a deferred tax liability means you are telling to your stakeholders that in the current year we paid less tax, but we'll be paying more tax in the future. Another concept is deferred tax asset. Deferred tax asset means you will be saving tax in the future. Deferred tax asset means in the current year you have paid more tax, but in the future you will be saving the tax. So repeat, deferred tax liability means organization will be paying more tax in the future. Basically in the current year they have paid less tax. Deferred tax asset means entity will be saving tax in the future because in the current year they paid more tax. A very important point. If you're paying less tax today, then you will be paying more tax in the future. So that is a deferred tax. You need to recognize a deferred tax liability. If you have paid more tax in the current year, but you will be paying less tax in the future, then you need to recognize a deferred tax asset. It means the difference is a temporary difference. It's not a permanent difference, because if you are paying less tax today, you will be paying more tax in the future. It means the saving is not permanent. If you are paying more tax in the current year, then you will be saving tax in the future. So basically, the differences are temporary differences. Now listen. Deferred tax, either asset or liability, deferred tax arises only from temporary differences. Temporary differences means the difference of the timing. Basically, we are talking about timing differences. So deferred tax arises only from the temporary differences. That's it. It means we will study if there's any permanent difference, you cannot recognize a deferred tax, either asset or liability. Because IAS 12 is very clear on that point, and IAS 12 says deferred tax arises only from temporary differences. Now listen. There are two types of temporary differences. There are two types of temporary differences. We have two types of temporary differences. One is taxable temporary difference. Taxable temporary difference. Another is deductible temporary difference. Another is deductible temporary difference. Okay. Taxable temporary difference into tax rate gives you the deferred tax liability. Taxable temporary difference multiplied by the tax rate gives you the deferred tax liability. Deductible temporary difference multiplied by tax rate gives you deferred tax asset. Deferred tax arises just from temporary differences. Temporary differences means we're talking about the timing differences. There are two types of temporary differences. One is taxable, another is deductible. Taxable temporary difference into tax rate gives you deferred tax liability. Deductible temporary difference into tax rate gives you deferred tax asset. Okay. Now the question arises, how do we know which difference is taxable and which is deductible? Because if we know this is a taxable difference, then okay. Taxable difference into tax rate gives us deferred tax liability. Deductible difference into tax rate gives us deferred tax asset, but we need to know how to find out the taxable difference, how to find out the deductible difference. To understand the taxable and the deductible difference and why taxable results in deferred tax liability, why deductible results in deferred tax asset, in order to understand all these, you need to know one concept. You know one concept. After knowing one concept, you will be able to understand all this. The name of that concept is tax base. Now you might be thinking, what do you mean by tax base? You might have heard many times that a student, they say our base is very strong, or our base is very strong. But right now I'm discussing tax base. So what do you mean by tax base? Actually, tax base means value attributed. Value attributed to assets or liabilities by tax authorities for taxation purpose, for tax purposes. So simply tax base means value attributed to assets or liabilities by tax authorities for tax purposes means what? According to tax authorities, what is the value of your asset and what is the value of your liability? That is tax base. Repeat. Tax base means what tax authorities think is the value of your asset and is the value of your liability. So tax base means value attributed to assets or liabilities by tax authorities for tax purposes. Okay. Now there's a question. How do they assign value to our asset or liabilities? We're discussing that. But you need to first understand tax base means what is the value of your asset, what is the value of your liability according to the tax authorities. Now, number one, let us discuss tax base of assets. Let me give you before giving you the examples of tax base of asset. First, there's one concept which you need to understand. What is that? We are discussing assets. Now listen. Just let me change this. In case of assets, if carrying amount of the asset is more than the tax base, what is tax base? I'm coming. How do we find out tax base of asset? I'm telling you. Just wait. If carrying amount of asset is more than the tax base, then the difference is a taxable difference. The difference is a taxable difference. And we know that taxable difference into tax rate gives us deferred tax liability. Carrying amount means the amount which is written in SOFP. If your assets are having carrying amount more than the tax base, if assets are having carrying amount more than the tax base, the difference is a taxable difference, and taxable difference into tax rate gives you deferred tax liability. Okay. If assets carrying amount is less than the tax base, if assets carrying amount is less than the tax base, the difference is a deductible difference. Difference is a deductible difference. Deductible difference into tax rate gives you deferred tax asset. If the carrying amount is less, tax base is more, the difference is deductible difference into tax rate gives you deferred tax asset. Okay. This relationship is exactly opposite for the liabilities. Liabilities. In case of liabilities, if the carrying amount is more than the tax base, In case of liabilities, if the carrying amount is in the more than the tax base, now you'll be having a deductible difference. The difference is called deductible difference. Obviously, into tax rate, it gives you deferred tax asset. In case of liabilities, if you have carrying amount less than the tax base, now it will be a taxable difference. Now the difference is a taxable difference. Taxable difference into tax rate gives you deferred tax liability. Okay. Now the time has come that we should be discussing how do we find out the tax base of assets and liabilities. It's simple, it's not difficult at all. Basically, if I tell you the tax base of few assets and liabilities, then automatically will come to know how do we assign the value, how do we find out the tax base. Number one, if I talk about land, tax base. Basically, the tax base of the land is its purchase price, cost of the land. So it is very much possible that you have kept land at a revalued model. It is possible. So whatever carrying amount you are having in your books, that is not important for tax authorities. The important point for tax authorities is the cost of the land. So in case of land, the tax base is the cost of the land. Second, if you have any investment, let's say you have investment in XYZ company shares. Obviously investment we apply IFRS 9 financial instrument. The point is, in case of investment, tax base, I'm discussing the tax base, okay? In case of investment, tax base is the cost of investment. These are the assets. Cost of investment. Tax authorities do not accept whatever the fair value of investment you are showing right now. They're just interested to know you bought investment at what amount. So in case of investment, the tax base is the cost of investment. Third, another example of tax base. For example, let's assume you have net debtors. Question, what do you mean by net debtors? Net debtors means from the debtors, let's say you have deducted allowance for bad debt. From the debtors, you have deducted provision for bad debt. Basically, in SOFP, when we show the debtors amount, in SOFP, when we show the debtors amount, what do we do? From that debtors amount, we deduct the provision for bad debts. So net debtor means basically net of provision for bad debts. Let me give you an example. For example, the debtors amount is 10,000. Provision for bad debt, assuming provision for bad debt. Let me write properly. Provision for bad debt. Assuming provision for bad debt is 2,000. So in SOFP, you will be representing 8,000. So the carrying amount of the debtor which comes in SOFP, it will be 8,000. But the tax base, if you ask me the tax base of the debtors, carrying amount of the debtors in SOFP will be 8,000, but the tax base will be 10,000. Because tax authorities do not accept provision. So obviously you have deducted the provision while showing debtors amount in SOFP, but the tax base will be 10,000. Because tax people don't accept provision for bad debts. Okay, another example. In case of property, plant and equipment, how do we find out the carrying amount? Basically, in case of property, plant and equipment, assuming the plant is costing 1 lakh, I'm just assuming, okay, the data. Accounting depreciation is assuming 20,000. So the net book value of property, plant and equipment is 80,000. That becomes the carrying amount of property, plant and equipment, okay. When it comes to the tax base, property, plant and equipment, the cost is 1 lakh and we'll be deducting the tax depreciation. The method will be given to you, assuming the tax depreciation is 25%. Yes, I'm assuming. So the tax base will be 75,000. This will be tax base. So basically, property, plant and equipment tax base is equal to the tax written down value. Tax written down value means cost minus accumulated tax depreciation. So in case of machinery, in case of property, plant and equipment, the tax base is tax written down value is the tax base. Okay. Another could be. Let's talk about liability. If I talk about warranty provision. Warranty provision. Tax base is always nil. Why? Because tax authorities do not accept any provision. If they're not accepting any provision, so obviously the tax base will be nil. So the warranty provision will have a tax base always nil because tax authorities do not accept provisions. It could be any asset, it could be any liability. If tax people says we don't accept, then that asset or that liability will have a tax base 0 because they're not. If someone is not accepting your asset as an asset, someone is not accepting your liability as a liability. So obviously they will not be assigning any value to that asset or liability. So if you come across any question where examiner says tax people are not accepting this liability, tax people are not accepting this asset, then obviously the tax base will be 0 because they're not accepting it. If they're not accepting it, then obviously the tax base is 0. Okay. So these are the few examples of tax base. They will really help you. Now we'll see the question as well, inshallah. In SBR, it is highly unlikely that examiner is going to ask for the calculation of tax base. I just give you a little bit knowledge. How do we calculate tax base of asset and liabilities? But in SBR, they're not. It is highly unlikely that such calculation comes. But still, you should be having a little bit idea what is the tax base of land, investment, debtors, and property, plant and equipment, warranty provision. That will really help you. And another very important point which I said, if you come across any question, it could be any asset, it could be any liability. If tax people say we don't accept that, then the tax base will be 0. Now let us, another thing, please dear student, you should be having a really good grip on this relationship. In case of assets, if carrying amount is more than the tax base, carrying amount is the more than the tax base, then the difference is taxable difference. If carrying amount is less than the tax base, difference is deductible difference, and deductible results in deferred asset. And for liabilities, we have exactly opposite relationship. So my advice would be, try to memorize these two relationships relating to assets, and for liabilities, just remember one point, opposite of assets. So that could be my suggestion, advice, whatever you think is coming. Let us just apply the knowledge which we just tried to get. We need to calculate carrying amount, tax base and temporary difference. Okay. A machine costing 1 lakh, depreciation is 18,000 has been charged to date, tax depreciation is 30. Now listen. 1 lakh minus 18 gives you the carrying amount. 1 lakh minus 18 gives you the carrying amount of 82,000. 1 lakh minus 30 gives you the tax base of 70. Logically, this 12,000 is a taxable difference. it is a taxable difference. Because obviously machine is an asset, carrying amount is more than the tax base. According to our relationship, it is 70,000. So the carrying amount is 82, tax base is 70. So the difference is 12,000 and that difference is a taxable difference. You can see the relationship which I just discussed. Interest receivable in the statement of financial position is 1,000. Interest receivable in the statement of financial position is 1,000. The interest will be taxed when received. A very important point. Tax people will take tax on this interest, but not now. They will take interest, but when it is received. Repeat. Interest receivable in the statement of financial position is 1,000. The interest will be taxed, but when? When it is received. It means right now it is not received, it is receivable. And tax people, they're not accepting your receivable. They're saying, we will get tax, not now when it is received. So basically, interest receivable as receivable is not acceptable by the tax authorities. They are saying we will take tax when it is received. But right now it is not received, it is receivable. So the tax base is 0. 1,000. It is a logically, again, it is a taxable difference according to the relationship. Because it is an asset having carrying amount more than the tax base. Trade receivable having a carrying amount of 10,000. Trade receivable having a carrying amount of 10,000. Trade revenue has already been included in the taxable profit. That is very important. You are having a receivable of 10,000, okay, and they are saying the revenue has already been included in the taxable profit. So the revenue is already included in the taxable profit. Now listen and listen carefully. What is the double entry of basically receivable? Receivable debited and sale is credited. They are saying the revenue, other part of this receivable, is already included in the taxable profit. If other part of the receivable, which is a revenue, is already included in the taxable profit, so logically the impact is already included in the taxable profit, so whatever comes, that it means there will be no future tax consequences because it is already included in the taxable profit. So no more deferred taxation. Deferred tax only arises when there's a difference between accounting and taxable tax treatment, and that difference will be over in the future, because we know that the difference is temporary. But if the accounting and tax treatment is same, then deferred tax will not arise. So please read the point number 3 again. It says the carrying amount of the receivable is 10,000, but the revenue is already in the taxable profit. So logically, it will have the same 10,000, because right now accounting and taxable profit is same. Treatment is same. Inventory has written down by 500 to 4,500. Basically, we follow IAS2, and IAS2 says cost and NRV, whichever is lower. But tax authorities do not accept such reduction at all. Inventory is written down by 500 to 4,500 in the statement. The reduction is ignored for tax purpose. They ignore this 500. Tax authorities do not accept this reduction. If they are not accepting the reduction, then according to the tax authority, inventory value is 5,000. It is not 4,500. Repeat. You have reduced the inventory by 500. Okay. In your accounts, the inventory amount is coming 4,500. That is also okay. But tax authorities, they are saying, no, we do not accept this written down of 500. So it means according to the tax authorities, the stock value is 5,000. So there is a difference of 500, which is a deductible difference, because this time carrying amount of asset is lower than the tax base. So it is a deductible difference. Let's talk about the liabilities. Current liabilities included accrued expense 1,000. This is deductible for tax on a cash paid basis. Very important one. You have a liability, accrued expense, simply expense, debit, and accrued credit. Tax people are saying we will give you this expense as deductible, but not now. Not now. When you will pay in the future, then we'll give you this as an expense. Not now. Read the question. It says this is deductible for tax on a cash basis. So right now it is accrued. They are not accepting the accrued. If they are not accepting accrued as a liability, so the tax base will be zero. So this 1000 will be a deductible difference. I'm showing deductible difference negative. Don't go for the mathematics. Otherwise, mathematically, you might be thinking 1000 minus 0 should be 1000. Why negative? Just to differentiate deductible from the taxable, I'm showing deductible with the bracket. So that is deductible difference because it is a liability. Accrued expense having a carrying amount of 5000. The related expense has been deducted for tax purposes. They have already deducted. Actually, read this one. Over here, what is happening? Accounts and tax treatment is same as I discussed earlier also. Whenever there is no difference between accounting and tax treatment, then carrying amount will be equal to tax base and there will be no temporary difference at all. Accrued expenses, the carrying amount is 5000 and related expense is already deducted for the tax purpose. Already deducted. I hope I have given the answer. Okay. So you can see this. Now let's talk a few more concepts. Actually, in IAS 12, I did discuss that deferred tax. IAS 12 categorically says, and IAS 12 is very clear on one concept, that is, deferred tax arises only because of the temporary differences. If there is any permanent difference, then deferred tax will not arise. And for those permanent differences, we say these are the exceptions, and you are not supposed to recognize any deferred tax. IAS 12 income taxes states that deferred tax should be provided on all taxable temporary differences unless the deferred tax liability arises from. It means if it arises from these two events, then you should not be recognizing any deferred tax liability. Goodwill for which amortization is not tax deductible, but nowadays there's no amortization. We don't amortize goodwill, actually we impaired goodwill. Goodwill for which impairment is not tax deductible. Goodwill for which impairment is not tax deductible. Due to that goodwill, if any taxable difference comes, let it come, but you're not supposed to recognize any deferred tax liability. Logically, that is creating some sort of a permanent difference. So goodwill for which impairment is not tax deductible, you will not be recognizing any deferred tax liability. Let me make it more easy. In case of group accounts, in case of group accounts due to goodwill, you will not be recognizing any deferred tax liability because tax people do not accept group as one entity and they don't accept goodwill of the group as well. So that is why goodwill can never result due to goodwill. You will not be recognizing any deferred tax liability, even though there will be a carrying amount of the goodwill and tax base will be zero because tax authorities don't accept goodwill. So you might be thinking that goodwill is having a carrying amount and tax base is zero, so there should be a taxable difference. Mathematically, the difference will come, but on that difference, you will not be recognizing any deferred tax liability because this difference will never be eliminated. So that is why you are not supposed to recognize any deferred tax liability. So simply you need to remember one point. In case of purchase goodwill in a group accounts, due to that goodwill, no deferred tax will arise. The initial recognition of an item that affects neither accounting profit nor taxable profit and which does not result from the business combination. The second exception is you're recognizing the initial recognition of an item. You're recognizing something, it could be asset, could be liability. But at the time of recognition, it is not affecting accounting nor taxable profit and which is not a result of business combination. Simply the difference is not arising in group accounts or due to group accounting. The second point says the initial recognition of item that affects neither accounting profit nor taxable profit. Let me give you the example of second. For example, you bought a property, plant and equipment for $100 million and your company says it has a useful life of 5 years. Okay, useful life 5 years. Day 1, what will be the entry of day 1? Property, plant and equipment debited by 100 million, assuming the bank is credited by 100. So day 1, you can see the debit and credit. At the time of initial recognition means at the time of transaction. Look at the debit and credit. This debit and credit is not affecting the accounting profit. It is not affecting the taxable profit as well. Okay. Company says we will depreciate this property, plant and equipment over 5 years. Now look at the tax authorities. Tax depreciation is not allowed on this property, plant and equipment. Basically, tax people are not giving you any depreciation on this property, plant and equipment. In other words, tax people are not accepting this property, plant and equipment as an asset. And now this difference will not be eliminated. So basically, they are saying we will not give you any tax depreciation. Sorry. So what is going to happen? Every year your company will be depreciating and the 20 million depreciation will come 100 divided by 5. And you will be accounts people, they will be deducting accounting depreciation 20 million every year, and tax people, they will keep telling you every year add back that 20 million because we do not give you any depreciation on this property, plant and equipment. So difference will never be eliminated. How it could be eliminated? If there was a tax allowable depreciation. But tax people are saying we will not give you any tax depreciation on this property, plant and equipment. In that case, we will say we are not going to recognize any deferred tax on this particular asset because the difference will not be eliminated. That is the second point. Initial recognition of item that affects neither accounting profit nor taxable profit and which does not result from the business combination. Deferred tax asset should be recognized in all deductible indemnity differences unless the exceptions above. Because of above, you are not supposed to recognize asset also. If the asset is coming because of this point 1 and 2, you will, if it comes, you are not supposed to recognize even the asset. Another point, insufficient taxable profit are expected to be available in the future against which deductible indemnity difference can be utilized. Basically, if you are having a deductible differences, we know that deductible differences multiplied by the tax rate gives you the deferred tax asset. But IAS 12 says if you will be having insufficient taxable profit are expected to be available in the future against which deductible indemnity difference can be utilized, then do not recognize a deferred tax asset. What do you mean by this? Assuming you are having deductible differences. Deductible differences means in the current year, let's say you have paid more tax and in the future you will be saving tax. But if you are having deductible differences right now, in the current year you are having net deductible differences, and deductible differences into tax rate gives you deferred tax asset. Deferred tax asset means in the future you will be saving tax. You will only be saving tax in the future when you will be having taxable differences in the future. If your company estimates that we will be having insufficient taxable profit are expected to be available in the future, against which deductible difference can be utilized, then you should not be recognizing a deferred tax asset. Repeat. Assuming in 2022 you are having taxable and deductible differences, but the net differences are deductible. We know that deductible into tax rate gives you deferred tax asset, but before recognizing a deferred tax asset, You need to check, will you be having sufficient taxable profit in the future against which deductible differences will be utilized? If you say no, then you should not be recognizing a deferred tax asset. Recognition exemption example. On the reporting date, Inchalada purchase a factory building 1 million, recognizes this as a property, plant and equipment in Chalada's jurisdiction. The building is not deductible for tax. Tax rate is 20%. The carrying amount is 1 million. The tax base is nil because tax people do not give you any tax appreciation. No deduction are permitted. As such, taxable difference 1 million arises because, just a minute. Because the carrying amount will be 1 million, tax base will be 0. Temporary difference will be 1, there will be a taxable difference according to our relationship. But due to this taxable difference, you should not be recognizing a deferred tax liability because it is the exception. Let's see what they are saying. Despite the fact that the factory building will generate taxable income at least 1 million, otherwise asset carrying amount is overstated, thus tax charge at least 0.2 million over its useful life, no deferred tax liability is recognized. This is because temporary differences arising from initial recognition of item has not affected accounting profit, the asset was capitalized, or taxable profit, the asset is unrecognized for tax purposes. The logic behind this exemption is that recognition would not provide useful information. Think about the double entry. Deferred tax liability credit. What should be debited? The debit cannot be posted to P&L or OCI because the transaction itself has not affected those statements. To date, the transaction has been recorded in property, plant and equipment, but debiting property, plant and equipment with further 0.2 million would make little sense. Would reduce the understandability of the finance. Would make little sense and would reduce the understandability of the financial statements. But the debit cannot be posted to P&L or OCI because the transaction itself has not affected those statements. To date, the transaction has been recorded in property, plant and equipment, but debiting property, plant with a further 0.2 million would make little sense, not more than that, and would reduce understandability of the but it would reduce the understand. It will not increase the understandability. So for debiting further 0.2 million property, plant and equipment would make little sense and would reduce the understandability. So what is the point of then recording any 0.2 further property, plant and equipment? So that is why we say it is an exception and do not recognize any deferred tax liability because of that. Okay. Before, sorry. Let's see what they're saying for the measurement. Measurement. The tax rate in force or expected to be in force when the asset is realized or liability is settled should be applied to the temporary differences to calculate the deferred tax balance. IAS 12 specify this. Simply, this rate must be based on legislation enacted or substantially enacted by the reporting date. Either they have simply the tax rate, either it has been changed on the reporting date. If not, then you can say substantially it's going to be changed in the reporting date. In that case, you should be recognizing your deferred tax asset or liability according to the new tax rate. Deferred tax asset and liabilities are not discounted to present. We never discount deferred tax asset, we never discount deferred tax liabilities because we exactly don't know when we'll be paying more tax and when we'll be saving the tax. Exact timing is not known, so you will not be discounting. We never calculate present value of deferred tax asset and liabilities because exact timings we don't know when we'll be paying more tax and when we'll be saving tax. Okay, let me give you another point. Another concept is very important. For example, let's say carrying amount in tax base, assuming, just an assumption, you have a land 100 million Assuming organization has kept this land at IAS 16 at revaluation. We know that in case of land, tax base is the cost, assuming the cost is 80 million. Okay, temporary difference. So there is a temporary difference of 20 million, and this difference is a taxable difference. Why taxable difference? You can see that carrying amount of the asset is more than the tax base, so the difference of 20 million is a taxable difference. Okay, land having a carrying amount of 100 million, and I just told you organization is following IAS 16 revaluation model. We know that in case of land the tax base is 80. If the tax base is 80 but the carrying amount is 100, then difference 20 million is definitely representing the revaluation. So over here this 20 million, the difference which is coming, it is just coming because of revaluation surplus into the tax rate assuming 30%. I'm having a deferred tax liability of 6 million. Now the question is, what should be the double entry? Obviously deferred tax liability will be credited. Obviously, let me properly show you the calculation a little bit so that you should not be having a problem. Land costing 80, revalued during the year, revalued amount is 100. So carrying amount, tax base, temporary difference. Land carrying amount is 100 million, tax base is 80. The difference of 20 is coming just because of revaluation surplus into tax rate. I'm getting a deferred tax liability of 6 million. Deferred tax liability of 6 million. Now listen and listen carefully. According to IAS 12, you need to check if your deferred tax liability is arising due to equity item, then it should be charged to equity. If it arising due to P&L item, it should be charged to P&L. Right now, the taxable difference of 20 million is just because is coming because of the revaluation surplus. Difference between these two values is representing a revaluation surplus of 20. So right now your deferred tax liability is coming arising because of the revaluation surplus. So that revaluation surplus will be debited. So you have to debit the revaluation. Revaluation slash OCI will be debited by 6 and deferred tax liability will be credited by 6. So the concept is you need to find out why deferred tax liability is arising. If it is arising due to revaluation surplus, then it should be charged. It must be charged to revaluation. Simply, if it is arising due to OCI item, then it must be charged to OCI. If it is arising due to P&L items, then it should be charged to P&L. Okay. Deferred tax asset and liabilities are not discounted. The entry to the P&L or OCI in respect of deferred tax is the difference between net liability asset at the beginning of the year, net liability or asset at the end of the year. It is important to note that if the item giving a rise to the deferred tax is dealt in the P&L, the related deferred tax should be presented in the P&L. I just discussed this one, if the item giving rise to a deferred tax dealt in other comprehensive income, the related deferred tax should also be recorded in other comprehensive and held within the equity, as we just discussed. Presentation: deferred tax liabilities and assets are presented as non-current. If there is a deferred tax liability, it will be in non-current, shown in the non-current liability. If there is a deferred tax asset, it will be in non-current assets. Deferred tax liabilities and assets are presented as non-current on the statement of financial position. IAS 12 notes that deferred tax assets and liabilities can be offset as long as the entity has a legally enforceable rights set of current tax and current tax liabilities. The deferred tax liabilities related to tax levied by the same tax authority. Obviously, you can net off the deferred tax assets and liabilities provided that those deferred tax assets and liabilities are arising from the same taxation authority. only then you can net off. Otherwise it becomes otherwise you cannot net off. So I hope you have understood. Net off is allowed when your deferred tax asset and liabilities are rising relating or relates to the same tax authorities. Okay, let's see what this question says. Using the information, this deferred tax, leave this. Non-current asset, that is the question 145 which we did. Question 145. There was a taxable difference of 12,000, taxable difference of 1,000, deductible difference of 500, and deductible difference of 1,000. So it gives you the 11,500 a taxable difference. There will be a deferred tax liability because the carrying amount of the net asset and liabilities exceed their tax base. The deferred tax liability is calculated by applying the tax rate, which is this. The double entry will be tax expense debit and deferred tax liability will be credit. Explain which tax rates should have been used to calculate the deferred tax liability for inclusion in the financial statement for the year ended 30th April X4. BRIC is a company with a reporting date 30th April X4. The company obtains tax relief for research and development expenditure on the cash paid basis. Okay. The recognition of a material development assets during there, in accordance with IAS 38, created a significant taxable temporary difference as at 30th April X4. The tax rate for the companies at the reporting date was 22. On reporting date, it is 22. On 6 June 4, the government passed the legislation lower the company rate to 20% from 1st January X5. Now listen and listen carefully, dearest friends. We are right now at 30th April X4. The legislation is passing after the reporting date. If the legislation is passing after the reporting date, then it is a non-adjusting event according to IAS 10. So we 20% will be applicable, but not from 30th April onwards. It will be applicable from 1st January X5. So simply 20% is not enacted on the reporting date. Since 20% is not enacted on the reporting date, so we'll be using 22%. Deferred tax liabilities and assets should be measured using the tax rate expected to apply when the asset is realized. Okay. Tax rate must have been enacted or substantiated enacted by the end of the reporting period. The government enacted 20% tax rate after the period end. That is very important. Therefore, it should not be used when calculating the deferred tax liability. For the year ended 30th April X4, the current 22% should be used instead. Per IAS 10, changes in the tax rate after the end of the reporting period are non-adjusting event. However, if the change in the tax rate is deemed to be material, then BRIC should disclose this rate change and estimate of the financial impact. You can disclose it. Specific situations, revaluation, I think this one we have discussed. Deferred tax should be recognized on the revaluation of property, plant and equipment if there is no intention to sell the asset. Any tax due on the gain on any sale of asset deferred tax by ruling rolled over against the gain of cost of the replacement asset. Revaluation gains are recorded in other comprehensive income, so any deferred tax arising on the revaluation must be recorded in OCI. We have seen that. Just look at this. Explain the deferred tax implication on this situation. An entity Dodge owns a property, plant and equipment cost is 1 lakh. Property, plant and equipment is having a cost of property, plant and equipment cost 1 lakh when purchased. Depreciation 40,000 has been charged to the reporting date March X1. Depreciation is 40,000, which means the carrying amount is 60. The entity claimed total tax allowance of the asset is 50,000. Tax allowance means tax depreciation. Cost 1 lakh. Tax allowance means tax depreciation is 50. So the tax written down value is 50,000. Tax written down value 50 means 50 is the tax base. Okay. On 31st March X1, the asset is revalued to 90,000. From 60, you have revalued to 90. Okay. Tax rate is 30%. Now, dear student, try to understand. The carrying amount of the property, plant and equipment was 60, but you revalued to 90. So there's a revaluation surplus of 30,000. Now listen. Carrying amount, tax base. The carrying amount of property, plant and equipment will be 90,000, but in that 90, there's a 30,000 revaluation. Don't forget that. Tax base is 50. Property, plant and equipment, the carrying amount is 90,000, tax base is 50. Temporary difference. The temporary difference is 40,000. Temporary difference into tax rate, the tax rate is I believe 30%. Pretty much common. So we are having a deferred tax liability of 12,000. Okay. Now let's make a double entry, debit and credit. Obviously, deferred tax liability will be credited by 12,000. But according to IAS 12, if your deferred tax liability arises from revaluation surplus, then it will be charged to revaluation, it will be charged to OCI. Obviously, this 30,000 is a revaluation surplus which has been recognized in OCI. So logically, this 40 is also having the impact of 30,000 revaluation surplus. So what I'm going to do, just telling you. So if I divide this 40 into two parts, logically 30,000 is a revaluation surplus and 10,000 impact is because of P&L item. So 30,000 into 30% gives me 9,000, and that will be 3,000. Look at the entry. Simply OCI, or you can say revaluation. OCI or revaluation, you need to debit by 9,000. Tax expense means P&L, debited by 3. Deferred tax liability will be credited by 12. Because when your deferred tax liability arises from revaluation, so it will be charged to revaluation. Let's see the explanation, what they are saying. The carrying amount of the asset is 90 and the tax base is 50. So there's a taxable difference of 40. The temporary difference will give rise of a deferred tax liability of 12. Okay. The asset was revalued 30,000. The revaluation gain recorded in OCI. So let's go to the entry. OCI debited by 9, profit or loss, tax expense debited by 3, liabilities credited by 12. The balance on the revaluation reserve within the other component of equity will be 21,000 because revaluation initially it was 30,000, but revaluation is reduced by this 9,000. So net revaluation will now in your other component of equity will only be 21,000. Share option scheme. So dear student, inshallah, the next class on IAS 12 in which your IAS 12 will be completed inshallah. We'll be discussing different relationship of IAS 12 with different IASs, like the relationship between IAS 12 and IFRS 2, the relationship between IAS 12 and IFRS 9, the relationship between IAS 12 and IFRS 16 leases. So we'll be discussing these relationship inshallah in the coming class, and there will be a little bit more discussion on deferred tax asset in the coming class. So I would say most probably that in the coming class inshallah we'll complete the IAS 12. So simply thank you very much for watching this lecture. Have a nice life.